Hey everyone, it is Evan here from the Trade Risk on Monday, March 4th, here with video number 2 in our series on long-term market technicals. Last month we did our first video kickoff here looking at the big picture view. This is all of the major asset classes, major markets out there, looking on a monthly time frame, long-term trends going back 5 to 10 years, and really to get a sense of what's going on in the market to help inform our shorter term sort of day-to-day or week-to-week trading decisions. I think these videos help give us just that big picture structure, the view, the context, if you will. And this is video number 2. I don't think we need to do them any more often than once a month because frankly these charts don't change a whole lot. But I do think kind of keeping a pulse on this big picture view is helpful, certainly at least for me, hopefully for you guys as well. And just as last week, we're going to run through, I think we got 16 charts that we're going to look at today. And the one difference this week, and I immediately regretted this decision when I published last month's video. I was almost going to take it down because I published the wrong set of charts. I actually published the chart deck in arithmetic scaling, the default sort of point value scaling, if you will. And I really wanted to switch over to a logarithmic view for the long-term charts. Now, just a quick mention on this because this is a question I get often is, you know, what's better? What should I use? The most, and I know there's people that have strong opinions on this and I don't, frankly, but the most important thing to me is that you understand the scaling that you're looking at. That is the most critical component because if you don't understand the scaling, then you could be sort of, you know, led to believe sort of a different sort of set of developments that aren't really there. So in other words, to give you a quick example here, and this is sort of a side, so I don't want to go spend too much time on this question, but this here is now log scaling. So the difference here is that if we look at this move from 7,000 to 8,000, right, all the way back in 2009 in the Dow Jones, 7,000 to 8,000, that's a 1,000 point difference. That is approximately a 14 or 15% rally going from 7K to 8K. So that's a pretty big move. If we think about that same 1,000 points up here at, you know, 24,000 to a 25,000 point rally, so from 24K to 25K in the Dow, that 1,000 point is actually now only 3%, 3.5%, 3.25% for a percentage difference move. So in the standard arithmetic scaling of a chart, it's going to treat every 1,000 points the same. It's going to think that, you know, it's going to paint the picture that every 1,000 points is a certain distance. And we know that if we are actually thinking in terms of percentages, which is I think what we care more so about as traders and investors looking at long-term charts, I think percentages kind of really tell the true sort of story because the 1,000 point rally up here at 25K is much less significant than the 7,000 to 8,000 point rally back in 2009. So when we look at log charts, it adjusts for that distance. We're essentially looking at percentage moves instead of point value moves. So hopefully that makes sense. Again, as long as you know what you're looking at, you could use any chart that you wish. There's no right or wrong way. I do think log charts give you, generally speaking, from most traders' standpoint, the more kind of honest view. But for short-term swing trading stuff, I still use point value charts, arithmetic charts, because if I'm looking at setting up a trade and looking at R multiples and all that good stuff, and shorter-term time frames where scaling is not as significant, it's a minimal difference. But a different conversation. I wanted to address it though and bring up the point that this video, you're going to see trend lines maybe a little bit different and some of the support resistance we're looking at maybe a little bit different. And that's because we switched over the scaling to the log view. Of course, we still have the same indices that we're looking at, the same real price trading has taken place and all of that good stuff. So without further, let's jump into this month's sort of analysis here for all these major markets. So we're kicking things off with the Dow Jones once again, and we can see here that we are continuing this nice bounce off of this lower trend line. So this trend line that extends all the way from the 2009 lows. We tested it. We basically breached it or undercut it back in December. We had a fierce snapback in January, follow through on February, and we are back into this range. So for the Dow Jones and for many of the US major averages that we're going to look at. We're kind of now sandwiched in between this significant multi-year trend line and the highs made from last year and early January of last year and October-ish of last year as well. So we kind of have this resistance right under 27K in the Dow, and we have this upper trend line, which is going to be important to pay attention to. We're bouncing now, and when we look at this long-term view, it's really not unreasonable to expect us to potentially get back up to resistance and test that level again in the coming months. It's not a prediction, it's not means that we have to get there, but it certainly looks reasonable when we're looking at a monthly chart to find support. We did get support. We got buyers stepping in on this test of this trend line, and now we're rallying higher. And now if we head back up and kind of challenge this resistance to see if it's still holding as, in fact, resistance, if sellers are still going to show up there, that would be the test to pay attention to. So for the Dow Jones, and I think for many of the major US averages, it's a waiting game here. We are in between a rising trend of support, which is held for multiple years, and we have this newly found resistance, and we're kind of in the middle of it, waiting to see sort of what will happen. So if we kind of scroll down here and look at the S&P 500, it's a very similar situation. We are much closer to kind of already testing some of the overhead resistance here under 29 or around 2,900. We're about a few percent away right now. We've again seen a nice rally off of this more shallow kind of trend line here, and maybe a little bit cheating on drawing this trend line, this slope like this, because it hasn't been tested multiple times like the Dow has over the years. But still, we had that thrust lower. We had that breakdown attempt. We did see the kind of higher low or attempted higher low at this point, right? Because it's technically not a higher low until after the fact, until we start breaking to new highs. So we have buyers still showing up around that 2,400 mark. We've bounced a few hundred points off of those lows. We have 2,900 above us, 2,400 below us. That's the playground that we're in, but we are still in a very long-term uptrend still. If we start to break down below 2,400, that's where things get quite dicey. I would expect, you know, a move down towards 2,100 if we were to really start to break down and make new lows and really start to put in a much deeper, you know, 30+% pullback off of the highs. So that is the structure there in the S&P 500. Nasdaq Composite, we can see here, not as close to the highs. It hasn't been as an aggressive of a rebound, at least not yet in the Nasdaq. It did find this nice, you know, thrust off of testing support here, multi-year support going back to the lows of 2010. But notice we are still decently off of the, you know, 8,000, a little over 8,000 highs that we made in the middle of 2018. We are above the trend line. We're below the highs from 2018. So again, very much a wait and see. Bulls on the long-term basis still have trends at their back, and we're waiting to see if we can get up there, challenge resistance, and figure out what this market wants to do. The Russell 2000 has a slightly different look here, or at least you could paint the brush with this type of upward sloping channel here, and you could be actually quite optimistic on the Russell 2000 to say that it has one of the most room to run to the upside here, in the sense that it did test the lower end of this channel, as it has done over the past 5 or 6 years, and now it is in the progress of rallying higher. And if you do believe in this channel here, and you believe that these lows can hold, then there's quite a lot of room up to probably around 1850 or so, 1900 in this channel to get back up to the upper end of this slope here, if this pattern and if this general trajectory is going to stay afoot here. So the Russell 2000, while it is still, you know, only about a 40% retrace off of its highs at this point, which is much lower than, say, the S&P 500 or the Dow, it does have potential here in this pattern. If we do believe that this channel can stay up, and if we do think it's tightening a little bit, then maybe this is some type of wedge that terminates years down the road. Again, not really interested in being that specific on these types of trend lines drawn. It's just to give us a general guide of the slope and trajectory. So when we look here at the Russell 2000, 1300, 1350, that's where buyers stepped up. That's the key level on the longer term to pay attention to. And we have ultimately the highs around 1700, and then the top end of this channel. That's what we'd be paying attention to in the coming months. Now, one chart that is quite constructive here, and this is one we talked about last month, was the advanced decline line. This is the cumulative view looking at all of the NYSE stocks giving them a sort of point value of 1 each. And as they progress higher, we do just kind of count, the boxes up and make a summation, so to speak, of the advanced decline line. And what we see here in the NYSE AD line is that we've already broke out to new highs. So while, again, minor highs at this point, but we did eclipse the highs made in 2018. So while price is still below all of the resistance, all of the 2018 highs, we actually have market internals. We have the AD line, which is leading, which is giving us sort of a bullish divergence, leading the market to the upside. That is generally a constructive behavior, is when the AD line is out in front leading to the upside. So that is constructive for equity markets as a whole. I do remain sort of optimistic here in the fact that this is broken out to new highs. If it suddenly reverses, if it rejects hard, then, things are potentially changing or shifting. It's not a guarantee that we have to rally in the equity markets, but it's certainly a nice to see. Now, our second market internal indicator that we like to look at is the number of stocks making new 52-week highs. So this is the 52-week highs minus lows index. So this is giving us the net advance, so to speak. And we are starting, this is something we talked about in last month's video, is we wanted to see expansion higher. We wanted to see the number of stocks making new 52-week highs start to accelerate to the upside, and we're starting to see that. We still haven't got as much back into, say, the 200 plus realm like we've seen in the strong uptrends of 2016 and 2017, early 2018. We were back at 200 plus for the number of stocks making new 52-week highs. Right now we're still in the 100s. So again, I'm being very sort of particular here. It's not the end of the world, but if we are going to see this rally continue and get some legs behind it, would really like to just see more expansion on the plus side here. And there's plenty of time for this to happen. So let's pay attention to this. Hopefully next month we can say, yes, we're starting to see 200 plus readings. That's encouraging. This broke out. Equity markets, potentially breaking resistance. Those would all be sort of the perfect harmony, the dance, so to speak, between these indicators. We'll see if that actually happens. If this turns south abruptly, if we start heading back into negative territory, that would certainly put me back into a more cautionary sort of disposition. But for now, things are fairly encouraging there. When we look here at the VIX, again, really not looking to do any technical analysis on the volatility index here, just showing the big picture of where we are. The blue line on this chart, so the blue moving line, is the 10-month moving average. You can see the 10-month, I'm sorry, I keep clicking that. The 10-month moving average is 16.55. That's about the average of the VIX, and you can see we are below that right now. So we peaked in volatility north of 30, almost 45 back in 2018. Now we can see that we are all the way cut in half back to the long-term average. So really not much else to say about it, just giving us kind of the big picture view of volatility. It's back to average levels, and it's probably what you would expect. In fact, probably going lower if we are to believe that this market can actually continue a longer-term rally. Now, next is the US dollar. I don't really have a whole lot to add to this one as well. It's very sideways and range bound in the big picture, since 2015, topping out at around $100. Again, it did have a brief breakout at 2017, and this is the dollar index, so it is euro heavy in its weighting, but effectively we've gone sideways here. We're in the middle of a range. We have had this uptrend since the start of 2018. So bulls do have the shorter intermediate term trends at their back, but longer term, we're still mostly sideways here in between, call it $89 and $100. That's what I'd be paying attention to. So lots of room for this type of, this type of market, for it to move around in the shorter and intermediate term, but for now, sideways, bigger picture. Junk market, so this is credit market, high yield. This has broken out to new highs as well. This is, again, another sort of encouraging, optimistic sign. It's kind of lump this in almost like the market internals basket, where we're starting to look for other clues and context about of maybe what the equity market's going to do. Well, credit market is a good market to watch. If there's generally, turmoil here, that generally does not spell good things for equity markets as a whole. So when we start to see the junk bond market, JNK ETF in this case, break out to new highs, that is encouraging. That says that there's some, risk on, there's some risk appetite. Things aren't breaking down in credit markets. So that generally has a good sort of backdrop for stocks. I like the fact that it's moving higher here. Not really looking to do any, hardcore technical analysis on the JNK ETF, but just measuring the fact that it's trading at new highs there. I do like to see that as well. So now we get into world equity markets. So this is the MSWORLD Index. This is basically all the markets outside of the United States. So this is actually ex-US. Take all global US equity market, take all global equity markets and remove the United States. This is what you have in the MSWORLD Index. So the world mostly fared much worse than the US did back in 2018. It did suffer a bigger pullback. It started that pullback earlier and just really kind of, nonstop pulled back for the entire year of 2018. Now, if we look here at this pattern, however, we do have this kind of upward sloping channel in place. And again, if we are to believe that this channel is in place and kind of dictating the price structure here, or giving us a good kind of mold and framework for the price structure, then we did see buyers step in December at the lower end of this trend line, at the lower end of this trajectory, and we're now kind of rallying higher here. There's lots of room to the upside if this structure is going to stay intact. So in other words, if you think this channel can hold and you think these lows are good, then you could be looking at a multi-year run here, certainly a multi-month run in the MSWORLD Index, all the way back up towards the highs as this has ebbed and flowed over the past 7 or so years. So something to keep in mind, maybe some outperformance there in the world versus the US relative. We'll have to see if that actually takes shape. Right now, I mean, it's still, at the bottom end of this retracement, it still has only retraced about 25% of the 2018 slide down to 1700. So there's lots of work to do, but there could be some potential here, something to consider for the longer term outlook here for world equities. Now, if we go to our second page, kind of sticking on world equity themes, we're looking here at the EEM. This is the emerging markets, iShares Emerging Markets Index. And I really like the setup here. I liked it last month. I still like it this month. We're basically kind of breaking out or retesting the breakout from early 2017 around that $41 level. So we went sideways in emerging markets here since really topping out in 2010 around $40, $41. This was essentially kind of a lost, almost a decade here of just going sideways for emerging markets until 2017, when this really started to break out and launch to new highs. Over the course of 2018, it pulled back and kind of flagged out, nice downward orderly channel here to retest and slightly undercut this breakout level, and now it's starting to pop back above. So again, maybe some outperformance here in the future. I like EEM as long as it can hold above, call it $40. It looks constructive to me if it can hold above $40 and it can start to resume its trend to the upside. I think it's an interesting place to be and think about for the bigger picture. If we go down to our next chart, this is Treasury. So this is long-term Treasuries, 20 plus years, iShares, TLT, ETF. And again, kind of similar to, I guess it's slightly a little different. It's its own animal here, but mostly sideways since 2015. It topped out at the end of 2014 around 122. It did have a brief stint here as it tried to break out in 2016 to new highs, but then it kind of fell back into this range, and it really, for the past 4 years, as headline driven and as much attention is put on rates right now and the long end of the curve, really hasn't gone too far in terms of a long-term trend. 110 to 122. This is after, this is again maybe the sideways consolidation, the sideways topping pattern, as many bears would say here, that is eventually going to lead to a breakdown. But we're going to need to see a breakdown below, call it 110 in TLT, to really get bearish here. Otherwise, we have a lot of noise, a lot of sideways range here, and just really a lot of patience and waiting for some of these bigger levels to really kind of break or give way. So for TLT, 110 to 123, that's effectively the range that I'd be paying attention to here. Those are the wide goalposts, and we'll see if we can get some type of resolve there in 2019. We are at the upper end of that range, but we are pulling back a little bit, so something to pay attention to, but it still looks very comfortable kind of moving sideways there. Next up is gold. So GLD, interesting pattern here. Lots of volume coming in over the past year or so, but we are still kind of in this holding pattern where we really haven't made a lot of ground or move trending action one way or the other since 2013. It's been moving sideways between, mostly, 1150 an ounce all the way up to about 1400 an ounce, 1350 an ounce for gold. And we're still there. We're still kind of now finding resistance recently. Last month, we had this kind of outside reversal month at that trend line at resistance. So we're starting to pull down just a little bit. The overall structure hasn't changed. We're still sideways here. So it's very much still a wait and see, kind of sit on your hands moment for gold. But that's the pattern we're looking at. I'm interested in it because it's nice and fueled up. It's charged up. It's moved sideways for quite a while. So it does have my interest, but at this time still is not breaking any significant levels. Now, silver here is kind of interesting as well. So in here, I've got a few different lines drawn and numbered them really. And when we look here at the history of silver since 2011, if we look here back at this point number 1, this is where silver topped out all the way up at around $48 an ounce for silver. And what we notice here is we had this initial pullback that had this steep slope, kind of labeled it number 1, very steep downward slope here, and that ended up kind of breaking out briefly in 2012, and then we started this more gradual slope to the downside, still in a downtrend and still fairly aggressive in its slope, but a little more gradual in this point number 2, and it did last longer as well, multiple years, all the way into the end of 2015, where we had another breakout. And that has led us into our current environment with a much more gradual slope. And notice that silver has not made new lows since 2015. So it's almost like that, I think there's that classic kind of 3 drives lower pattern that traders look at often in the markets for technicals. You can Google it. I'm certainly not an expert on it, but I know that there's lots of mentions of kind of that 3 drive lower in a downtrend. And then you kind of get that eventual breakout and reversal back to an uptrend. And maybe that's what we're seeing here. We're seeing slopes become a little more gradual. New lows have stopped happening, but if we take a look closely here at the recent past 2 months, we tried to break out above that $16 just a few weeks ago, and that ended up failing, and we're starting to fall back into this old range. Again, and this is the beauty of a monthly chart, there's no technical damage here. Structurally, nothing has changed. We're still in this holding pattern, but that's what we want to see is a move above 16, above this resistance line here. That's what we'd be paying attention to. We did have I had a position in silver for about a month or so earlier this year. Recently was stopped out of it. So just back on the radar, and we'll gladly get back into this trade if it sets itself back up. So that is silver. And I think last but not least, actually 2 left, is our commodities trend here. So oil, really, pretty much an ugly chart. I mean, it's just a horrific chart on a longer term basis here. We were in this, kind of rising wedge, if you will. We broke down very sharply at the end of 2018 or middle towards end of 2018. And now, this year we have seen a nice kind of sharp rally off of the lows, but it's still more or less in no man's land. Crude oil here, looking at the continuous contract, trading around 55 spot. Really just, there's not a whole lot of trend or anything to really get excited about. There's certainly opportunity in trends because it is so volatile on the short to intermediate term, but to say that there's something, apparent here on the long-term basis, there really isn't. The last big event was a breakdown of this wedge. This could be a bear flag that ends up sending us lower. But for me, you know, 42 all the way up to 70, I mean, those are it's a big range, and that's just some broad sideways horizontal levels I'd be paying attention to. But for this one, really going to defer to the short to intermediate term trends. There's more opportunity there. And last but not least is our good old friend natural gas here, which saw this epic spike higher at the end of 2018. I mean, the only chart that probably looks more, you know, less exciting than oil is probably natural gas. There's nothing here either. I mean, when we look at the big picture, and this is the spot contract for natural gas trading at 286. Really, I mean, this is where we've been for the past 10 years, trading around this level. We really have all but just a sideways move here. No trend to speak of. If anything, it's maybe slightly down. It is now, you know, I mean, the one, you know, good thing that the bulls can hang their hat on is for the past 2.5 years, we have held support around $2.60 in natural gas. So maybe we have a higher floor that is being developed here. That would be constructive so long as we can hold above 260. But for any meaningful move beyond a short to intermediate term swing trade, we really got to start trending and breaking some significant levels over $4 and maybe 50 cents. And you know, natural gas is a crazy one, so it can happen quick, but for now, it just doesn't look all that exciting. So holding above support, that's constructive. Stick to the short to intermediate term trends. It's volatile. There's opportunity there. Bigger picture, there's really not much else to say. So that is it. That is what I have in the long-term market technicals recap. Hopefully this was helpful, especially if this isn't something you traditionally look at. I like checking in on this, like I say, once a month, even once every 6 weeks or so. I think it can help you really kind of pop your head out from the day-to-day noise and get a sense of really what's going on there. So hopefully this video was helpful. Thanks so much as always for tuning in. You can subscribe to our YouTube channel. These will come out about every month. That's certainly the plan at least. And then you can follow us, of course, on our blog, thetraderist.com. Have a good rest of the day, good rest of the week, and we will see you in the next video update.